They've been incredible. When you look at the recovery that has happened in the US over the last 10 years, it's very, very impressive. When it comes to revenues, they brought back their revenue level to pre-crisis time. Margins are at their top level. We talk about 348 basis points roughly, which compares to the highest pre-crisis level of 322 basis points. Return on equity is nearly back to, let's say, the highest level of pre-crisis, so they've done extremely well. And this contrasts totally with the situation of European banks.
One fly in the ointment, or one thing that I think maybe the market might be concerned about, is just how flat the revenue line appears to be, though, for a lot of these banks. They've done better on profitability, but when you look at where they were on the revenue line and the kind of guidance that you're getting from the CEOs, the guidance is measured and slightly downbeat, I would say, on the outlook. But the revenue in particular doesn't seem to be growing from here. Is that something that investors should be worried about if they're still in these stocks?
In the US, yes, definitely, because we're at the end of a cycle, a macro cycle and a rate cycle, which has been extremely favorable to US bank. So of course, I think the best part is most likely behind us, and we should face probably a little bit more difficult times in the US. But what an incredible rally they've given us.
I was looking at some of the Wells Fargo numbers, and they were pointing to the net interest income, and effectively they had a decline in the gap on what they do in terms of issuing loans and taking on deposits. And this is a problem as we talk about a 25 basis point reduction or maybe a 50 basis point cut from the Fed. What impact would those two levels have if it was just a little bit of an insurance cut versus a much deeper drop from the Fed?
So this is very difficult to tell because it really depends from a bank model to another. But definitely, it's going to be impactful on margin revenues. It's a little bit more difficult to assess because when rates come down, the refinancing cycle accelerates between brackets, so volume may at some point increase. We've seen that on some occasion, but definitely you are talking about a decrease in profitability, which again, when we enter into this new cycle, may be a little bit difficult to assess as we speak.
Do you really think that there's going to be more appetite for mortgages, at least in the States? Because I was looking at some of the data for the housing market yesterday. US home building fell for a second straight month in June. Permits dropped to a 2-year low, and it does indicate that there's not that much appetite for mortgages, despite the fact that there's much lower mortgage levels. Many consumers are probably having a good run if they want to get a mortgage at this point. Demand seems to be an issue, doesn't it?
Yeah, that's true. That's true for now. But let's keep in mind that absolute rates are still high in relative value to the rest of the world. So again, probably depending on the Fed action over the next quarters, we might see some pickup in volumes. That's what happened in Europe, basically. So,
and let's just talk about Europe here, because I think what we've demonstrated, or what you've made clear, is that in spite of some of the issues around trading revenue and the investment banking businesses, largely the US banks have done well, and in particular those that are in the consumer space have done even better. I thought US Bank Court yesterday was phenomenal. Yeah. Let's just talk about Europe for a moment. Is there any reason to hope that Europe can follow where the US has already gone? As I look at this Euro Stoxx Banks chart, all that tells me is that there's still a lot of misery and suspicion baked into investors' sentiment around the European banking sector.
Yeah, it's an incredible paradox. When you look at European banks, they've delivered on capital. We're sitting on 14.7% of capital, which is the highest level ever. They've delivered on risk. When you look at the non-performing loan ratio, which is the key risk metrics people look at today, you're roughly around 3.10, which is again the lowest level ever. And let's keep in mind that the way we compute these two metrics today have nothing to do with the way you used to do it in the past. I mean, the capital intensity today in European banks is much higher than it was. Same for non-performing loans. It's only since 2014 that we're computing non-performing loans with roughly the same definition across Europe. So this is very good, and we've seen the industry completely transform, and in reality today, European banks look more like utilities than anything else. Having said that, of course, when you provision everything, when you have tons of capital, profitability looks miserable. So of course, today we're talking about 5 to 10% return on equity at best, even if we see banks that are over-delivering. Lloyds, RBS currently, UniCredit in Italy, likes of BNP in France. So we can see banks that do much better.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.